Hey everyone, welcome back to Corporate Decoder, the place where we dive into the nitty-gritty of corporate filings and try to make sense of it all for you. Today we are looking at Columbia Fund's Series Trust to SUI, specifically Columbia Floating Rate Fund and their latest annual shareholder report. Now this might sound a bit dry, but stick with us because within these pages are the details that reveal how this fund has been performing and what that means for the money invested in it. Before we get into the numbers, if you get value from these deep dives, please hit that like button and subscribe. We also have a Discord community linked in the description where we break down more corporate documents. Come join the conversation. This filing is essentially a report card for the Columbia Floating Rate Fund for the period ending the 31st of July, 2025. It tells us how the fund performed, what it invested in, and the costs associated with it for investors. Think of it as the inside scoop on where your money is working. Let's start with the costs for a hypothetical $10,000 investment in Class A shares. The cost for the reporting period was $104, which works out to about 1%. For Class C shares, that cost jumps to $181 or 1.75%. Institutional classes are cheaper, with institutional class costing $78 or 0.75%. These are the fees you pay to have your money managed by the pros. They might seem small, but they can add up over time. Now for the performance for the 1 year ending the 31st of July 2025, Class A shares returned 7.31% before sales charges and 4.08%. Including them, that is actually a little lower than their benchmark, the S&P UBS Leveraged Loan Index, which returned 7.60%. The Bloomberg US Aggregate Bond Index did much worse, returning only 3.38%. Over 5 years, Class A did better, returning 6.18% annually compared to the benchmark, S7.17%. But over 10 years, things look a bit more positive, with Class A returning 4.32% versus the benchmark, S5.22%. It seems the fund has been struggling to keep up with its benchmark over the long haul, especially when you factor in sales charges, which really eat into your returns. The fund itself manages a staggering $751 million. That is a lot of money. They hold 367 different investments, and their portfolio turnover rate, which is how often they buy and sell assets, was 84%. This means they are actively managing the portfolio, buying and selling quite a bit over the year. Looking at their top holdings, we see companies like UKG Incorporated, which is a software company, McAfee Incorporated, Primo Brands Incorporated, Proofpoint Incorporated, and Nielsen Consumer Incorporated. These are all significant investments for the fund. The largest holding, UKG Incorporated, represents about 0.7% of the fund. S-net assets. This tells us they are not putting all their eggs in one basket, which is generally a good sign. Getting into the actual investments, we see that about 2.8% of the fund is in asset-backed securities. That is financial products backed by pools of assets like loans or leases. They also have 1.2% in corporate bonds and notes, and a whopping 91.1% in senior loans. Senior loans are typically loans made by banks to companies, and they are called senior because they are among the first to be repaid if a company runs into trouble. This is a big concentration in one type of asset, showing the fund's focus on this particular market. We can also see some very specific investments here like Ares XXB Mine, Series 2024 to Tua Class DR3. CLO stands for Collateralized Loan Obligation, which is a type of asset-backed security backed by a pool of leveraged loans. These can be complex and carrying their own set of risks. The fund holds $3 million in this particular CLO. Now, let's look at the fund's statement of assets and liabilities as of the 31st of July 2025. Their total assets are a huge $778 million. On the flip side, their liabilities are about $27 million. This means the net assets applicable to shareholders are around $751 million, matching what we saw earlier. This shows a healthy balance between what the fund owns and what it owes. For Class A shareholders, the net asset value per S-share was $33.51. For Class C shares, it was $33.52. The institutional classes had values around $33.47 to $33.65. Remember, this is the price of one share of the fund. Looking at the fund's operations for the year ending the 31st of July 2025, we see they earned over $63 million in income from investments. However, they paid out over $6.7 million in expenses. After some waivers and reimbursements, their total net expenses were about $6.2 million. This left them with a net investment income of over $56 million. That is before we even consider realized and unrealized gains and losses. In terms of realized gains and losses, the fund actually had a net realized loss of nearly $6.6 million. This means when they sold investments, they sold them for less than they bought them for. On top of that, there was a net change in unrealized appreciation and depreciation of over $2.6 million. When you put it all together, the fund had a net realized and unrealized loss of almost $4 million for the year. This is a key point. While they earned income, the overall value of their investments decreased during the period. Despite the investment losses, the fund's total net assets actually increased by over $52 million. How is that possible? Well, it comes down to capital stock activity, meaning more money came in from selling shares than went out from redemptions. For example, Class A shares saw a net decrease in shares outstanding, meaning more money was redeemed than invested. But the institutional classes saw substantial increases in shares sold, bringing more money into the fund. Let us dive into the financial highlights for Class A shares. For the year ending the 31st of July 2025, the change in net asset value per S-share was $2.37. This came from about $2.47 in net investment income, but that was offset by a loss of $0.10 from realized and unrealized gains and losses. So, even though the fund made money from interest, its investments lost value. The total return before sales charges was 7.31%, but after sales charges, it dropped to 4.08%. This highlights how those sales charges can really impact your bottom line. The management services fees alone were nearly $4.9 million. That is a significant chunk of the fund's earnings, representing 0.65% of its average net assets. While this is a standard fee for active management, it is something investors need to be aware of. The notes to the financial statements offer some crucial details. Under security valuation, we learn how they value their assets. They use readily available market prices for most things, but for complex assets like some debt securities and senior loans, they use pricing services and even their own models. This is where some judgment comes into play, and it means the reported values might not always perfectly reflect what they'd get if they had to sell immediately, especially in uncertain markets. The massive allocation to senior loans, over 91%, is a critical part of this fund's strategy. These loans are generally considered to be at the top of the credit hierarchy, meaning they get paid back first. However, they also come with risks, including that they can be hard to sell quickly, which is called liquidity risk. The report mentions that for senior loans, the actual maturity could be shorter than stated due to prepayments. This is important because it affects how investors get their money back. We also see a section on unfunded commitments. This just means the fund has agreed to lend money in the future, but the borrower hasn't drawn on it yet. They have about $1.1 million in these commitments across various loans. While the fund earns some interest on these, it also means they need to have that money ready to go when the borrower decides to draw. The fund categorizes its assets based on how easy it is to determine their value. Level 1 assets are things with readily available prices like stocks traded on major exchanges. Level 2 involves observable inputs, and Level 3 assets are the trickiest, relying on unobservable inputs and management's judgment. For this fund, about $9.5 million worth of assets are in Level 3, and these are mainly senior loans valued based on broker quotes that might not always be easy to confirm because the market for these can be thin. This indicates a higher level of estimation in valuing parts of their portfolio. On the tax front, nearly all of the income distributed by the fund is considered interest dividends, specifically 99.92%. This is important for some investors for tax purposes, particularly regarding interest deduction limitations. Finally, the report includes an approval of management agreement. This details how the Board of Trustees reviewed and renewed the contract with Columbia Management Investment Advisors, LLC. They looked at performance, fees, the quality of services, and the profitability of the manager. They re-saying the manager is doing a decent enough job to keep their contract. The board concluded that the fund's performance fees and services provided by the investment manager were reasonable and supported renewing the agreement. So, what is the story here? The Columbia Floating Rate Fund is heavily invested in senior loans, aiming for income generation. While it generated solid income, its overall investment performance, especially when you account for sales charges and expenses, has lagged behind its benchmark over the long term. They are dealing with complex instruments like clause and senior loans where valuation can be tricky and liquidity can be a concern. The fact that a significant portion of their assets are in level 3, meaning their fair value is based on management, estimations rather than clear market prices, is something to watch. This indicates potential for greater volatility or challenges in selling these assets during tough times. This fund is clearly trying to generate yield through floating rate and senior loan investments, which can be attractive in rising rate environments, but they are facing headwinds in keeping up with benchmarks. What are your thoughts on this fund, S strategy and performance? Let us know in the comments below. If this breakdown was helpful, give us a thumbs up and subscribe for more. And don't forget to join our Discord community for more in-depth discussions. Thanks for watching, and I'll see you in the next one.